Thank you for watching Prepare for Your Funding Needs. I'm Michael Young. I'm the Senior Marketing and Member Solutions Officer. I've been with the bank for 11 years, held several positions in accounting, enterprise risk management, and lending, which I spoke with many of you while I was in that department. And today we're going to go ahead and discuss the regulatory focus, provide an overview of the tools and policy limits and how we can help. It's 2023, and with the bank failures in March, it's no surprise that regulators will focus on liquidity. We'll review these two customizable tools to help you with your documentation and ultimately increase your earnings by optimizing the amount of collateral available to benefit from your most reliable funding source. Again, these tools are free. I'm especially excited to discuss the building operational and contingent liquidity and liquidity stress analysis, as we've received extremely positive feedback from the members that have utilized them. So, brief overview on liquidity, right, is the ability to raise money quickly without a loss at a reasonable cost. Liquidity crisis as a handful of banks late in the first quarter proved that the ability to access cash quickly and at a reasonable cost is critical. Liquidity will remain at the forefront of examinations. Therefore, building reliable access to liquidity is essential to effective funding and liquidity management. One of the critical elements of sound liquidity risk management includes stress testing of primary, and secondary, and contingent funding sources. And despite our members' risk profiles being vastly different from the three banks that failed earlier this year, nothing has changed, and it will be important to regularly measure, monitor, and manage your liquidity. And this will include your contingent funding plans, making sure they're robust, enhanced liquidity stress scenarios, making sure those assumptions are appropriate, and they will also focus on interest rate risk and capital adequacy. If you look over here, we have the supervisory focus and that little pie chart. We did a response amongst our members before our annual management conference in April. So a lot of these responses too came in before the bank failures in March. And obviously a resounding 41% responded with liquidity being the main focus. I would venture to guess that number has climbed exponentially since this survey was taken. Other responses, the 15% included the earnings and capital. So that probably also increased a little bit. Now, building operational contingent liquidity, I want to get out there that contingent liquidity should not be confused with the term dry powder, which should really be called liquidity cushion, consisting of highly liquid assets or securities, but we'll get into more of that in detail later. Increasing your capacity with FHLBank allows you to further monetize on those already earning assets held on your balance sheet, as you're converting those illiquid, non-sellable loans into readily available and reliable liquidity. There are many benefits of an improved collateral position. We'll discuss just a few. An improved total liquidity position, one which includes pledged and available collateral, will help demonstrate solid operating flexibility and strong contingency plans. As we saw with the bank failures earlier in March, liquidity can irreparably damage an institution significantly faster than credit can. And we saw that unfold in weeks, days. Should a member experience sudden outflow of deposits, they quickly backfill using FHLBank funding. It's important to get ahead of that. It allows you to be more agile and quickly react to any stress scenarios or other liquidity needs, whether they were known or unknown. And then members can also be opportunistic about the investments they make now and capitalize on those opportunities to acquire those assets. All right, so this image, although it's a lot, is an overview of the entire building operational and contingent liquidity resource tool. It provides an overview of your current collateral position and estimated additional collateral, along with pro forma collateral position to help you optimize your capacity. And we'll break out, I'm going to stop and define what we mean by operational. So we'll get into that here in a bit. When I mean operational, I'll interchange that with term base liquidity, and we're going to separated out between base and contingent funding, right? And when I mean operational, that's your day-to-day liquidity, whether your seasonal funding needs or you had settle up at the end of the day for daily cash needs, or you needed to manage some interest rate risk. What really excites me about this tool is it allows us to help you develop a base and contingency funding strategy that allows you to utilize FHLBank advances for a portion of your base funding, that day-to-day operational funding, while still providing you with sufficient contingency funding sources. All right, so now we're going to walk through each column, and starting on the left, that blue heading that displays your current pledged collateral position. This is where you currently sit. And as you can see with this institution, there's 7.9% of their total assets are pledged. And if we move over to the center column, that's the composition of the current assets pledged and the associated lending value. So unrestricted loans, securities, and restricted loans. Keeping in mind that restricted loans have a limit of 25% of your total assets. On the far right, which is the most exciting part, is how much additional capacity do you have on your balance sheet that you might be able to increase that capacity. We use your call report data to determine what that estimated additional capacity is. And then we'll add that to your existing capacity to get your pro forma position. And in this situation, you can see if all of that estimated additional collateral that we identified was eligible collateral, they'd increase to 247.3 million. And you get an overall pro forma collateral position, lending value adjusted, of 315.3 million. And we won't go over this in detail, but another part of this tool you might have noticed on the small screenshot was we can do a peer comparison on how much other members are pledging relative to their asset size. So on this slide, we're going to discuss here in this example that there was the current capacity position before we applied the additional capacity was 7.9% with a base funding limit of 5% and contingent limit of 2.9. The additional estimated collateral increases the overall borrowing limit to 36.4% or 315.3 million. That's a $247 million increase in available liquidity, while also increasing the base and operational funding limits to 20% and contingent to 16.4%. And in my lending experience, I've seen where an opportunity arises and collateral wasn't available. As a collateral-based lender, we need that collateral readily available. So you can call in late in the day and get that collateral. By having that, it allows you to fortify additional capacity. It allows you to fortify a sufficient buffer against deposit migration, the need to fill funding gaps when liquidity needs or other profitable opportunities arise. And then one last thing, when this is just an overview, we do have a collateral capacity analysis that we won't review today, but many of you seen it when you test your line. And it'll go into detail of what loan categories you could possibly want to target and identify for additional capacity. All right, the building operational and contingent liquidity analysis supports the position that not all powder or capacity at FHLBank needs to be kept dry. While it helps you evaluate the liquidity position and better articulate and justify to examiners, an improved liquidity position helps reduce that examiner's concern while also improving operating flexibility and strengthening your contingency plans. And I think that's going to be one of the key things in having those conversations with examiners. Allocating a larger portion of the funding limit to base or operational liquidity, that'll give you greater access to FHLBank advances, which, as you know, we're the most quickest, reliable, and often the cheapest source. with a wide array of products to help you manage interest rate risk or any other daily and seasonal funding needs. It allows you to manage your overall funding costs as margin compression persists, and you can look at your marginal cost of fund analytics and when your deposit base is under pressure, much like it is today. How much is enough? There's no magic number, right? It's going to depend on your preference, policies, guidelines, examiner preference, situational analysis, cash flow projections, stress analysis. It gets really muddy. So it's all going to come down to what's specific to your institution and your overall liquidity risk profile. Now, before we move on to the liquidity stress analysis, it's important to factor in lost business opportunities, competitive disadvantages, and decline in revenue from paying up for deposits or other high-cost emergency funds. Diversified funding sources and tenure of funding should be identified and included in your plan. These sources should be regularly tested to confirm quick access and take an extra step to identify and monitor the main factors that would impact the availability of those funds. What would trigger you from not being able to access those sources, especially in a stressed environment? This is an overview of the liquidity exercise tool and what you'd receive if you requested it. I understand it's small, but we just want to provide an overview. And this analysis also uses your most recent call report data and other customizable assumptions as appropriate assumptions will provide the biggest benefit. So we'll dive in here on the stress scenario assumptions, which is the most important piece. The two biggest factors that will impact the analysis are deposit outflow and loan growth assumptions, while also including other factors such as the total broker deposit runoff, listing service deposit runoff, maturing time deposit renewal, and the inflows. Allows you to get a little overview of where this is a 12-month projection, and we can customize all of the stress scenarios. This is just a starting point. And as we move over, so now we'll move on to the cash flows. And again, this is a 12-month horizon. We'll look at those maturity time deposit renewals on the inflows. And then on your uses or outflows of funds, the non-maturity deposit runoff, time deposit also includes broker deposit runoff, listing service deposit runoff, and other borrowings that are maturing in the next 12 months. This is important, goes back to my point earlier on the few slides ago about making sure what would impact the availability of those funds, your access to those in a stress. So if those broker deposits, listing services, or advances matured, what would impact your ability to access that funding? And noting that and documenting that. And here we're using our loan growth. For standard, we're just going to go ahead and use what your prior 12-month loan growth was and apply that. Again, assumptions are what are going to provide the greatest result and benefit to you. And you can see at the bottom, there's that net scenario cash flows for each scenario, low and moderate and high. And we'll flow over here to see on the FHLBank borrowing capacity, how that transitions. So you see that blue highlighted section, that's what transferred from the bottom of the cash flow section. And as you can see here, we'll walk through many things. We're providing just an overview today, but it shows where your current excess collateral shortfall is. And then we apply the 40% limit, which is that's an FHLBank. Majority of our members have a 40% of total assets limit on borrowing. So that's something to keep considered back when we'll talk about keeping flexible policies, probably should be 40%. And this will indicate how much collateral will be needed to meet those liquidity needs in a low, moderate, high stress environment. That's what's key there with that current excess collateral section. In this example, you can see that the high stress event indicates the need to identify other funding sources and why multiple funding sources are useful. And that will come up in an examination, having diversified funding sources. One of the things this kind of makes me ask myself is, have you reviewed your policies to ensure that you have meaningful borrowing flexibility with sufficient collateral pledge to secure funding if needed? Most loans that you originate and hold in portfolio are illiquid assets, and in some cases, even held in your maturity portfolio. We did not review the metric comparison at the bottom left, which illustrates the impact of liquidity and funding ratios for each scenario. And this can be adjusted based on current policy or potential policy changes, or both. And I will say again, the better the assumptions, the better the results, and the better the benefit. All right, so liquidity stress testing and contingency funding planning. The results of stress testing should play a critical role in your contingency funding plans. Dale Scheller with Baker Group wrote a great article for our members on liquidity risk management. One thing that really stuck out to me was focusing on the high impact, low probability type scenarios, as it's not what you expect to happen, it's what could possibly happen. And it's easy to get into that day to day, well, oh, that's never happened to me, or that will never happen. But that just really resonated with me, that section. And that article is out there on our financial intelligence page. It takes time to identify additional eligible collateral. We know that. And we want to make that, we certainly hope you make this part of your near-term contingency process. All right, so the financial landscape has shifted with retreating liquidity positions, declining market value in bond portfolios, loan growth and deposit base erosion, all contributing to increased utilization of wholesale funding, particularly FHLBank advances. Examiners, I call this 3Ds, the define, document, and defend. So you want to plan from a position of strength and be prepared. Revisit or enhance your liquidity, funding, and capital plans now. This will be critical when you continue to navigate the uncharted waters and the uncertain economic outlook. Uncertain is an underestimate. It's always to your best advantage to be able to communicate and explain to the board, examiners, and other parties why you elected certain funding sources or set limits at a particular level. Identify additional eligible collateral. If you haven't already done so or seen the collateral capacity analysis, I highly recommend requesting it. This provides your institution with an overview of loan categories that are eligible to pledge based on call report data. So they might not all be eligible, but it'll give you a good focus on where you should begin to identify that additional capacity. We also have the member products and service guide. It has the schedule of eligible collateral, which provides detailed descriptions of which securities and loans are eligible for pledging and the related underwriting requirements. Again, you can reach out to collateral and safekeeping operations, and we can help you identify assets that may be eligible for pledging. One consideration is to identify eligible loans as they are made to increase capacity. This could be documented in the loan file or coded in your systems to ensure that they are easily identifiable. And if they're not eligible, why are they not eligible? Because we could make a change and they do become eligible. We recommend having someone else within your organization or externally review those loans to make sure that they are eligible, or if one was determined ineligible, why, and maybe it should be eligible. The biggest takeaway here is I want you to please reach out to collateral and safekeeping operations to discuss any situations that come up as you're reviewing your loans to increase your collateral capacity. And they also have a lot of input on how you might be able to adjust your processes to improve efficiency and effectiveness. So we're going to do a quick recap on optimizing the amount of collateral pledged. Obviously, it will reduce examiner concerns. We discussed that. Enhance operating flexibility and strengthen your contingent plans. Pledging more of your loans, right? They're illiquid loans, so you can turn them into readily available liquidity from your most reliable source, which also helps you mitigate idle, non-productive cash from sitting on balance sheet, which also improves operational readiness. And again, you want to proactively manage potential challenges that may arise and should take into consideration the impact on future earnings, liquidity risk, and deposit migration. The overarching point of this slide is we want you to maximize your capacity with FHL Bank because we are the fastest, most reliable, and often the cheapest funding source to meet your liquidity needs. While also we can help you manage your interest rate risk with our array of customizable advanced products. Now, how can we help? Aside from these two tools, we have several other resources available to you. Supporting documentation. We have examples of funding worksheets and components. They'll be in the appendix of this presentation material. The Collateral Resource Center, that is a good place to visit. And there'll be webinars, recorded webinars, updated news, and other guides to help you and any new staff that come on board. And then we have our resource center that would include our financial intelligence articles, videos, podcasts, upcoming events, latest news. We do quarterly put out economic updates and trend reports. Members also find those very useful. If you go to the financial intelligence page, there's one article I'd like to point out. Well, it's actually a white paper. More core than core deposits, and it examines FHL Bank history and outlines the reason advances continue to be more core than core deposits and the most efficient funding source available to financial institutions. And as a cooperative, our goal is to help be your trusted financial partner by providing you with these resources and strategies that contribute to your profitability and efficient use of capital. And ultimately, we want to help you enhance the value of your membership. Here's a list of the member solutions page that you can visit. And this is where you would request any tools or analysis resources available to you. And again, all these are free as part of your membership. If you'd like to see some of the examples, they will also be in the appendix. And to request them, you'll click on the link. You can go out to the page or click on the link in this presentation and fill out a form. And the more you include on like what your assumptions, right? Maybe you want to have a phone call about that, but you could, and more information you provide us as we prepare this, the better the results and benefit to you would be. And this is the marketing and member solutions team. One last thing I want to reiterate is not to hesitate to reach out. Here, this last slide, this is a screenshot of our public site, FHLBankTopeka.com. And you can click on the resource center and it'll have the upcoming events. And that would be like a regional meeting, an annual management conference, and any webinars. We also have the videos and podcasts available out there, that financial intelligence section I referenced several times throughout this video, and any latest news. Thank you again for joining us today.